this is our first session of the year, so I'm excited that we're kicking off, I think, January with an exciting topic. I'm really excited about these presenters. They're pretty impressive. So that we, that just all changed. I think it's going to be a good conversation tonight. So just kind of as a reminder, what we do is, and I will monitor the chat, you're more than welcome to say hello, share your information, share any contacts that you have. We usually share, like, if somebody's got a book recommendation. That reminds me, there is a new book that came out. I just got my copy. I don't know if anybody is familiar with Kate Kenny from Ireland. She just has a new book published called Regulators of the Last Resort: Whistleblowers, the Limits of the Law and the Power of Partnership. I haven't read it yet. It just came in the mail. But from what I understand, it's a really good look at the role whistleblowers play in oversight, which I thought was a little timely for our session tonight. So I'm going to let each of our speakers introduce themselves. As a reminder, we record these sessions and then they're posted online. So if you don't hear everything you thought you wanted to hear, or you want to watch it again later, or you want to share it with other people in your network, you're welcome to share them. They'll be on our YouTube channel, and Paul has arranged for us to be on the podcast platforms like Spotify, so you can find us that way as well. So without any further ado, I'm going to ask each of our speakers to do a sort of their own 5-10 minute introduction of who they are, where they are, what they did, and then we'll get into the disclosures. That usually runs about a half hour, and then we open it up for discussion, Q&A. I'm always just sort of mindful that we should be respecting each other's time, give everybody a chance. I'll try to monitor questions that come up in the chat. So if you don't want to come on camera or you don't want to ask something out loud, you can put it in the chat and I will keep an eye out for you. And then we'll circle back around. The hour always goes fast, so without further ado, because Everett is on our board, I was going to let him go first and introduce himself.
Sure. Thank you, Jackie. I appreciate you having me on. My name is Everett Stern. I'm an HSBC whistleblower. So back in 2010, I worked as an anti-money laundering compliance officer for HSBC Bank. HSBC essentially was, not essentially, but they were laundering money for terrorists and drug cartels in the tune of billions of dollars. So I reported to my supervisors. Of course, they were going along with this type of criminal activity and terrorist financing and drug cartel financing. So I started passing information to the CIA and the FBI. I later on reported to the SEC. This was much later, though, after I left the bank in 2011. And then my story has been featured on Rolling Stone magazine, Netflix, international media. But I definitely, tried doing the right thing by stopping terrorist financing. And, it was very hard, man. I lost everything as a result. And then I had to build up again in order to succeed. And now my mission is to help other whistleblowers and help try to make a significant positive difference and to prevent terrorist and drug cartel financing from happening at other financial institutions around the world, which unfortunately is still an ongoing issue.
All right. Well, thank you. Elon, why don't you tell us a little bit about yourself and what your disclosures have been about?
Thanks for having me first and foremost. I was telling Everett, I did watch his show on Netflix. It's actually really cool. Whoever hasn't watched it, but I'm a 4-time SEC whistleblower. I started working in the life insurance industry for MetLife at the time, and I didn't do any kind of whistleblower while I was there. I simply started to research a problem. I noticed that there was a problem with the design of universal life insurance policies. It's a permanent cash value life insurance, or at least it's sold as a permanent cash value life insurance policy. And I started to see that they weren't permanent. They were designed to fail. And I went the route of visiting a bunch of lawyers who said that the contract disclosures and wording were perfect. They basically were written by the greatest attorneys on earth. And then I submitted my first tip to the whistleblower SEC about my findings, a decade long of research. And state regulators in life insurance in the United States are useless. They're clueless. They have no clout. They can't do anything. And after being denied by about 6 lawyers in New York, Philly, Boston, Jacksonville, Zoom calls with Tennessee and California, and the SEC ignoring what I've done, I wrote a book. So the book that I wrote is called Lapsed Universal Life Insurance Whistleblower. It's an expose of the entire universal life insurance industry, not just MetLife. It's a systematic dissection and destruction of the universal life industry. But my marketing skills are negligible. My analytical skills infinitely superior than my marketing ones, which is why nobody's heard about the book. But I was not a whistleblower while I was at the company. But the fact that I'm a 4-time SEC whistleblower allowed me to be here and help people at least understand that they might have a problem with their life insurance, because what we just spoke of before the call, Jackie, is most people have no idea what they have. And the book and my whistleblower was designed to get people who have no idea what they have just to open up their policy to say, hey, wait a second, I might have a problem here. And right now, the regulators in Wall Street are ignoring me. But again, thank you for having me. Hopefully, I can contribute nicely to your
Yes. So where is the book? Do you have a version of it? And maybe we could put a link in the chat.
It is on Amazon. I suggest to people to wear welding goggles, because you might find yourself poking your eye with a pencil reading a life insurance book. But for those in the field, in the business, regulators, lawyers, attorneys, it literally explains all the things that nobody knows about, because I just have lived and breathed it for a decade.
Okay, well, I'm going to ask you to, while we go back to the banking whistleblowers, put your book in the chat, or Paul, if you know how to do that, let's share that resource. But let's go back, and so explain dirty money. How does money get dirty? I think it would be really helpful for us to understand the trajectory of how this even happens. So I'm thinking about this for a moment, maybe more from the consumer perspective. So I open up a life a savings account or a checking account in a bank. I put my money in the bank. What happens then? How does my money somehow end up in the hands of terrorists and drug dealers and all of this? And Everett, who wants to kick us off with that?
Yeah, I guess we jump in. So when you make a deposit at the bank, the money then gets laundered. So and laundering of money is the concealment of the source of funds. So let's say you're a drug dealer and you're out dealing drugs, and that's how you make your money. If you go out and buy a Ferrari or something, that's going to alert the government or the specifically the IRS that you have unearned unreportable income. So you need to find some type of job or you have to have to funnel that money into a legitimate business. So you're taking illicit proceeds and putting it into a legitimate business to essentially launder or wash that money. And there's three different yes. So once the money is laundered, then the banks have these compliance departments. So let's say you want to move money, Jackie, from Wells Fargo Bank, where you're banking now, or hopefully, this is for the purposes of this example.
Right.
But you're at Wells Fargo Bank, and you're trying to get money to, let's say, terrorists in Gambia and Sierra Leone in Africa, right? Let's just say you're trying to get to a Hezbollah cell there. I'm not saying this is actually what you're doing, Jackie, but it's just for the purposes of this conversation.
Highly unlikely.
Right. So anyways, Wells Fargo does not have a direct connection to, let's say, Standard Chartered Bank in Gambia and in Sierra Leone, or the local bank there. So what they have to do is they have to go through a bank like HSBC, which is a correspondent banking division. And that correspondent banking division, essentially these larger banks such as HSBC, Standard Chartered, JP Morgan, they act as the bank's bank. So they're the broker, they're the brokers of the bank's money. So when you go to make a deposit into the bank and you're trying to send money, you're the originator, and it's going to a beneficiary over in Africa to this terrorist organization. So what happens is the compliance department at HSBC, in my example, is supposed to review those transactions and approve or not approve them based on them conducting due diligence and research into the originator and beneficiary, and whether it's a high-risk transaction or not. And if it's a suspicious activity, they're supposed to file what they call a SAR, which is the suspicious activity report, which then goes to Treasury. And that's a type of intelligence report, actually. And that's what alerts the government or the regulators that something is wrong and they can take action. But those funds are supposed to be stopped once a SAR is filed or once there's suspicious activity noticed. What happens, though, is that the bank's compliance officers or the department, they say, okay, you know what, we're going to approve these transactions. We're going to ignore the red flags, and we're going to allow the money to get to the terrorists over in Gambia or Sierra Leone, or the cartels in Mexico. And the reason why they're doing that is because they make money off every transaction. So, for instance, when you make a wire, you're charged a fee. Anytime that these banks make a transaction to the correspondent bank, there's a fee associated. So the banks are making money based on every transaction done. And the biggest problem is that the regulators keep fining these banks billions of dollars, which seems like a lot of money, but it's only weeks of their of actual profit. So in HSBC's case, they were fined $1.92 billion when I was there, and I blew the whistle on them. And that was only 5 weeks of their profit. So it's a too big to jail. And it's also a too big to fail type policy where people are not going to jail for this. But circumventing back to your original question, money becomes dirty the second that a banker or somebody tries to conceal that source of funds and they try to make illicit activity seem legitimate. That's how it becomes dirty. And I know it's a very basic blanket statement, but it gets more complicated than that. But the actual mechanisms of it, but that's essentially dirty money.
Okay, so these are transactions that the person making the transaction knows from the beginning that what they're doing is illicit. They're just washing it through the banks. It's not like somebody like me who has a 401k and it's, you're putting your money into this investment. I was thinking you get like a prospectus and it gives you all the lists and all the acronyms of all the places your money is invested. Is that what you mean by shell companies? Like if I'm looking at a prospectus from, like Putnam or Destiny or any one of those guys, would I be looking at potentially shell companies when I see that prospectus?
So a shell company is something a little different. But I but let me just go back to a very good point you made, Jackie, is that so when you have a 401k or you're putting money into a financial institution and you're innocent, you're not trying to conceal the source of funds, you're not doing anything illegal, but you're putting money into, let's say, a bank, HSBC or another one of these other banks that is conducting that type of criminal activity. What happens is that the banks need your money in order to operate. They make money by collecting deposits and then by issuing interest on those deposits. So the bank does take that money and they do distribute it to terrorists and drug cartels. And I'm not saying all bankers are doing this. There's a few bad apples out there, and there's a lot of good people too. But yes. The second you put your money into an institution that's conducting illicit activity, that money is still part of the larger whole of dirty money. So a lot of people, they think that, well, because they're not doing anything illegal, but even though that money gets commingled with everyone else's money, and that money then goes to terrorists and drug cartels or other types of illegal operations. So my advice to people is that if you're you need to bank somewhere or you need to put your money into an institution, do your due diligence and research into where that money is going to make sure that the people that have the custody of your money are not doing illegal things that you know of. And right now in the news, we know that certain financial institutions and corporate entities are conducting illicit activity. So what we should do as consumers is not simply not do business with those entities. But that's a whole other topic in and of itself. But again, the shell companies is something different though. And Jackie, if I can just also comment that why this is also very, very important is because there's a thing called Bank Secrecy Act. So so Bank Secrecy Act, there's Know Your Customer, KYC rules. There's all these different. So the United States government has Bank Secrecy Act, and financial institutions and what they call an MSB, a money servicing business, they have to comply with Bank Secrecy Act. All corporations in the U.S. have to do it, and in order to do business with our overseas partners, they have to follow it as well. And it's very, very important because if Bank Secrecy Act is violated, that's a national security issue. So all these things that we're talking about, shell companies, KYC, due diligence, it all falls under that. It really all falls under that Bank Secrecy Act umbrella. Just a comment there.
No, I appreciate that. I know Elon had a comment he wanted to make earlier, but I did want to get back to our trifecta here of the banks, the brokers, and the insurance companies. I think we get hit up on that all the time. Go ahead, Elon.
I just had a question, like how, because I worked as a branch manager of a bank, financial specialist way back when, in the late 90s, early 2000s. We had the large currency transaction reports. If somebody deposits more than $10,000, how do they get around that? Like, in the movie that would in your Netflix show, I see these people, coming in with all these dollar bills. Like, how do they get those dollar bills deposited into a bank? Obviously, you can wire money in some way, but how do they get stacks and suitcases worth of dollar bills into the banking system?
Yeah, it's a great question. So in the movie Dirty Money on Netflix that I'm in, episode 4, Cartel Bank, you're right. It describes how cartels and terrorists were showing up at the bank with literally garbage bags full of cash, and they were depositing that way. And that's done through corruption and by bribing bankers and having that relationship there. Also, the bankers are not reporting those actual currency transactions. So if it's under, let's say it's what they'll do sometimes, what people will do is they'll deposit under the 10K trigger. So they'll deposit $9,996. They'll under that 10K trigger, and then a SAR is supposed to be generated, that suspicious activity report, but then the banks don't report on that. They don't file that SAR or stop the transactions. Now, in my situation with HSBC Bank, and I can't comment on this with other banks, I wasn't there to witness it, but at HSBC there was criminal manipulation of the wire filter, which is something different, where you had these organizations and people that were actual sanctioned entities by the Treasury Department, by OFAC, the Office of Foreign Assets and Control, that were sanctioning entities, people and also corporations. and such as Hezbollah, for example, is a sanctioned terrorist organization. And what there's a company, for instance, I talk about this in the movie called Tajiko. I use it as one of the many examples that I saw there. But Tajiko was in the wire filter because there was a SAR that was filed. And that means that every transaction going to this company called Tajiko, which is a Hezbollah, which are actual financiers for Hezbollah, those transactions are supposed to be stopped by the bank because they're in the wire filter, right? But the problem is that I don't know how I caught this, but I just figured it out. I was at my desk one day and I was wondering how all these transactions were getting through, because there was this thing called the Customer Alert Monitoring Program where it had just every transaction HSBC was doing for years and years. And I saw that just all this money was getting to these sanctioned entities, and I couldn't figure out how they were doing it. And then I saw in this one example with Tajiko, instead of it being spelled TAJCO, which is the actual spelling, it was spelled TAJ.CO or TAJ-CO in the filter because it required an exact match. And that's how the bankers were criminally manipulating to get money from one entity to another with it circumventing the actual filter itself. So I know I kind of expounded on your question a little bit, but that's how money's actually, it's supposed to be stopped, and there's systems in place by good people who are trying to stop these transactions, and you have bad threat actors that are committing crimes and doing the wrong thing. And again, I just want to reiterate, I think what's very important out there is for more whistleblowers to come forward and for the good guys to do the right thing, and you have to prevent these bad threat actors from committing these types of crimes. But because again, we're talking about dirty money here today, but we're also talking about how we stop dirty money, and the way you do that is by people stepping forward and by actually stopping it.
No, I thank you for that explanation. I think that was really helpful. It was a good question, Ilan. So let's actually now to the insurance companies. So I buy a policy that I think is a really good deal. Tell me why it's not.
Okay. I was an investor, and this will take like 4 or 5 minutes, I think. I was an investment broker during the dot-com crash out of college. I saw the dot-com crash. I was a subprime mortgage underwriter for Merrill Lynch. I was right in the middle of the crash, had a toxic resume, started working for MetLife. And up until the late 70s, early 80s, there were two predominant life insurance policy types. One is term insurance, a great product. You rent it for a period of 10, 20, 30 years. It's really cheap, takes care of your family really well, but does expire worthless. But it's an awesome product. And whole life has been around for over 100 years. It's based on a guaranteed premium, guaranteed cash value, guaranteed death benefit, plus a dividend that the large insurance companies, a policy dividend that the large insurance companies have not missed in over 100 years, because 98 to 99% of those term policies expire worthless. So where whole life is safe and guaranteed, mathematically and ethically a good product, when interest rates climbed in the late 70s to 8, 10, 12, 15, 14%, people were taking money out of their safe whole life policies, earning 3.5% to 4%, to invest in money markets, earning 8, 10, 12%. It seems like a rational idea for a consumer. So as the insurance companies feared this exodus of cash value from their safe whole life policies, they created this thing called universal life. But in doing so, created a policy with multiple design flaws, rising internal charges based on no guarantees. These new policies were using a census based on the 1980, 2001, or 2017 census, which suggests death at 77, and Jimmy Carter just passed away at age 100. So there's different kinds of universal life insurance. There's something called universal life, index universal life, variable universal life. They all have the same flawed design chassis. Their investments just are slightly different. But in my book and my research, I basically proved that they're designed to fail rather than to succeed. And I think they're legal, in quotes, but I also think they're predatory, deceptive, misleading, and unfair. So what happens is, you may have received a universal life policy in 1990 where the money is invested in money markets when interest rates were 8, 9%. The insurance companies, who are supposed to be, these great mathematical geniuses, not only suggested you're going to make 8, 9, 10% in a money market, but they suggested you were going to make an 8, 9, 10% money market rate of return every year eternally. Guess what? Interest rates dropped to 0 in 2022 because of COVID. So what happens is, at the point of sale, they show you this insane CD-like rate of return eternally, which makes no mathematical sense to anybody financially literate. And you're happy because you see a large death benefit, a lot of cash value. But when reality sets in and the actual returns are lower, you don't have enough cash value to support these rising costs. So what happens is, you, the consumer, think that the policy that I wrote to you is holy because I coached your kid's soccer team. But the illustration with these universal life policies is merely a projection of what the policy might do. So the big part of all this, and part of the whistleblower and part of the book, is there's something called an in-force illustration. That is the current policy projection. It says what the policy did from inception, let's say 1990, until now, and what it's projected to do going forward. There's no law requiring the insurance companies to send that report to you on an annual basis. So you, the policyholder, are in the dark. You don't realize that your policy is getting more and more worthless with every passing day. And the insurance companies love that, because the longer you keep the policy and the older you get, and the higher cost of insurance start to creep in at age 75, 80, 85, when you might not even be cognitively impaired, right? Or even aware of what's happening in your policy, the policy lapses because there's no more cash value. And in doing so, you lost all your premiums, all your cash value, all of your death benefit. And I think that 90% of these universal life policies are in trouble. And I have proof. I literally looked at 5,000 individual policy totaling over $1 billion in death benefits, which is a large enough sample size for anybody mathematically inclined to know this is not just a one-off advisor who wrote it. It's a slew of advisors, and it's not just MetLife, it's the whole industry, because their policies are designed very, very similarly.
No, okay, so I think that was a really good explanation, and I think I would encourage you to put your email in the chat, because I bet people are going to want to chat with you about what their policies look like. I know I do, and how to maybe think about, if these are legal, what would make them not legal, and how could we maybe involve the Consumer Financial Protection Bureau in something like this, and maybe get more transparency.
Yeah, and the follow-up to that is I searched online. I live in South Florida. I looked at what's the states with the best consumer protection laws. Boom, it shows Massachusetts. I spoke to the Massachusetts Insurance Fraud Bureau of Massachusetts. They liked my research so much that they made a formal complaint to the Attorney General of Massachusetts. They did nothing. Why? Because the Attorney General is a bunch of lawyers. They don't understand math. They don't understand policies. And this is too big of a problem for them to put on their 9-to-5 plate. I then had a meeting with the SEC in Philadelphia. Executive. He understood the problem. Nothing happened. So, and just to give you a size of how big the problem is, there's 5 large whole life companies, another 5 or 6 that no one's ever heard of. That means the rest of the industry primarily is writing these universal life policies, which make no mathematical sense. But to give you a sense of how big this is, Bernie Madoff stole $25 billion. It wasn't 50, it was 25. The 50 was the bogus statements he was sending it to consumers. After the government clawed back early investors who exited whole, it ended up being like a few $1 billion to a bunch of rich people. This is trillions of dollars of lost premiums, lost cash values that are depleted by rising internal costs, lost death benefits, trillions of dollars to average people making $1,200, $1,300 in Social Security with negligible 401ks, pretty much zero financial literacy. Now, when you wipe out a $100,000 death benefit to someone in the 50th percentile and take out his $10,000 cash value, because he didn't understand that the costs are going to rise to crazy numbers, that's financial devastation to them. And that also makes Bernie Madoff seem like a petty thief that stole a pack of gum from 7-Eleven. This is grand scale. It's across the board. And I think it's unconscionable behavior, whether it's legal or not. Maybe if I ever get a chance to speak to somebody at the SEC, they'll determine it. But the product is a sham. The investment assumptions make no sense. But again, you know, if you're dealing with lawyers who don't understand basic mathematics, no offense to any lawyers on the call,
Yeah, there are a few.
that's the problem, right? So, you know, I'm here in the forum because although they dealt with things internally as they were employees, I just did a decade worth of research. I tried to go to the authorities. They did nothing. I submitted different SEC whistleblower tips, 1 in 16, 2 in 23, 1 in 24. All have been ignored. And, you know, I take comfort knowing that Madoff was allowed to walk around for a decade before the SEC decided to finally crack down on him. So I'm in that waiting for them to crack down on something.
Yeah, these cases can go on forever, as we all know. I haven't seen any questions in the chat. It's been a very quiet chat, so I can only imagine that it's because you guys have all been so engaging. I haven't seen any hands go up or any other questions, so I'm going to take a pause. Oh, here we go. All right, Bali, if you'll join us.
Can you hear me?
Yes, we can hear you. We can't see you.
So the question I had is, were you able to stay in your field after this happened to you? If not, why not? And if you were not, did you retire? Did you go on to something else? How did you recover, you know, from the aftermath of the retaliation that you went through?
Well, Everett, I think you started your own company.
I did, yeah. So, I mean, when I blew, again, I didn't really know what whistleblowing was when I blew the whistle, I guess. But now I was a 25-year-old kid, and I didn't know. I don't know. I was just trying to do the right thing, and I did face some retaliation within my company. I was demoted a number of times, and you know, the bank certainly put me through the ringer. But my real retaliation came after. You know, I had after disrupting terrorist and drug cartel money, you know, I put a real dent in some bad people's wallets, and I had a very real security risk coming from terrorists and drug cartels. I had the Sinaloa, Los Zetas drug cartel, Hamas, Hezbollah. I had, you know, ISIS, some very bad people that and they still want to see me 6 feet under. So you know, there are security risks there. But I did start my own company. I was blackballed from the financial industry. I ended up working at P.F. Chang's as a waiter, actually. P.F. Chang's was the only company that gave me a job after I blew the whistle. So I went from working at a Chinese bank to a Chinese restaurant. And you know, it was great. They gave me lo mein and me chicken. I ate that for a long time. They sustained me. I love P.F. Chang's. I'm a huge advocate of them. But and then I started my own company called Tactical Rabbit, which is a private intelligence agency where I linked up with the whole team. I put together a team of former CIA and FBI and NSA operators, and I continued that effort to go up against terrorist and drug cartel financing in the private sector, and tried to fill intelligence gaps within the USG from the private sector. And I went on to still fight the good fight, but I had to do it from the outside, though. I was definitely blackballed from the industry afterwards. But I lost everything as a result. I mean, there was no pat on the back for me whatsoever. I mean, it was very, very hard.
Ilan, I'm going to let you have a sort of a last word. It sounds like you work for yourself now.
Yeah, I started researching these crashing or lapsing policies as a hobby. And then I realized it wasn't just like a one-off scenario. It was an actual phenomenon. And I started researching on my spare time and kind of did my own thing, lone wolf stuff. And I submitted my first whistleblower tip the day after I left the company. I didn't want any part of a whistleblower dealing with employee, executives. And I was a financial advisor, so I'm pretty much self-employed in that capacity. And nobody knew that
So that's what you're still doing. That's what you're doing, though. You have your own financial advisor business.
Yeah, and only when my book came out all of a sudden, all these people around me said, "Oh my goodness, that's what you've been up to?" I was like, "Yep." And there's no shortage of companies that don't touch these policies for the most part. So I was easily employable in different places, because when you get somebody who really understands life insurance, who's really ethical, only sells the good stuff or advises on the good stuff, and could determine if you have the bad stuff, I'm in demand because I'm an expert on the topic, right? So I didn't have any of the stories that Everett had. But I think the biggest problem I have with this whole whistleblower idea is that contract wording, at least as it relates to life insurance, contract wording supersedes math and logic as far as the whistleblower goes. So I can show Everett a 12% CD-like rate of return of a mutual fund inside of a variable universal life insurance policy. It's a cash value life insurance is wonderful. It's a great tax shelter. It's like an unlimited Roth IRA with no 10% penalty for early withdrawal, right? So it's a great tax shelter when done correctly. But I can go to Everett and show him on an illustration from the company, and companies still do this, a 12p-like rate of return eternally in the stock market, which is quite literally a mathematical impossibility. But because the insurance companies made Everett sign the bottom, you're aware that this illustration is a hypothetical illustration and it's not guaranteed. They put the risk of the investment performance on Everett. I made the sale. I'm happy. The company has a life insurance policy that's permanent, in air quotes. That means Everett's going to give them $1,000 a month for the next 30, 40 years. They're going to liquidate the cash value via higher expenses when he's 90 years old and has no idea what's going on. And they're not going to pay the death benefit. That means it's an awesome business model. Promise a permanent death benefit, never pay the death benefit, use his cash and his premiums. It's kind of like it's a Shark Tank worthy idea, minus the fact that it's unconscionable behavior, right? So my big thing with the regulators are they're useless and clueless, and I think they only really look after themselves, and because a lot of these commissioners in the United States, they don't care about going after agency insurance company. They care about their next job on the board of directors of that same insurance company. So it's like the most they'll do is slap them on the wrist, right?
Right. Well, I know we're getting to time, but if somebody thinks they have a bad insurance policy, can they get out of it?
Well, yeah, there's an exit. If once you determine that there's a problem, there's an exit strategy. But I'm a financial advisor. That's what we do. But my goal is just for people with any kind of cash value life insurance to order an in-force illustration so they can see for themselves if it's in fact correct. And once they realize there's a problem, people like myself can certainly help them. I'm easy to find. I posted my email address. And,
I was just going to say your email's in the chat. You should put that, what you just said in the chat so people can see what that means. And then, I want to thank everybody for speaking about your experiences. I'm grateful that you're here helping us kick off 2025. Paul, if you want to either put in the chats or we'll be sending out reminders for next month. And of course, off the top of my head, I can't remember. I'm trying to think. Paul usually has me covered. But our next one should be February. Let me see, why can't I figure this out? February 18 or the 25th, Paul? I'm always confused.
February 25th, the journalist whistleblower relationship rules.
Okay, yes, we're going to tee up some of the journalists who are covering some of the stories that whistleblowers tell. And I think we've got a couple of good reporters, some good journalists that will really speak to some of the issues for just how to work with journalists, know the rules, and how do you make those kinds of disclosures? Because those are not, going to a reporter is not protected. So how do you know the rules, and how do you do that kind of paperwork? And yeah, like you were saying about evidence, what can you share, what can't you share? So we will reconvene in a month. And Paul will have this up online so that anybody can watch this again. Please share it. Always like and share us. We've also started our membership program is launching. We have a newsletter. We're trying to figure out ways to be engaged and keep everybody involved and engaged. So if you want to volunteer for anything, please let us know. And we'll see you in February. Happy Valentine's Day in the meantime. And I will see you soon. Thank you. Bye-bye.